Welcome to the Bitcoin Macro War Room, where we jack into the market mainframe and derug the narrative. Plug into the pipes, M2, DXY, inflation, momentum, fresh prints, CPI, ISM, payrolls, rates, truth by facts, not vibes. Tweets and news rundown, meme to policy, curated, timestamped, tradable.
Welcome, you've got mail.
Copium not included. Roll the tape, let's invest like it's 1999, but with better charts.
Are you scared yet? Is there a sinking feeling in the bottom, in the pit of your stomach? Well, good. That's exactly how you should be feeling, and you should be buying, in my opinion. And we'll get into all of that, why I think this is actually one of the last chances to get Bitcoin at these prices. We could still see a little further downside, but I'll show that all. I have a slew of charts for you today. I think this is perfect timing for the macro war room in terms of what has happened this week and the opportunity that lies ahead of us. So I'm still super bullish, and I'll explain why. I have some interesting tweets to go over. Of course, all the data, all the charts, all the on-chain stuff, but let's dive right in. Let's kick it off because we got a lot to go over and it's been another crazy week. So let's start it off. And what I wanted to do, given the price action, is just talk about my high level thesis really quick, just to zoom out and give you an understanding of how I'm looking at things. Again, I'm not a short-term trader. I am a long-term cycle investor. And this chart represents the majority of my thesis, which is that Bitcoin follows the business cycle, which is the ISM. Bitcoin follows liquidity, which is not shown on this chart, but is driven by the debt refinancing cycle. And obviously the dollar, which is a tailwind and kind of a responsive metric to liquidity and the business cycle itself. You can see ISM still under 50. DXY has rallied, and that has, rallied here. This is inverse, so it's actually dropped. And that has propelled prices 6x for Bitcoin already this cycle. And a lot of that's driven by M2 liquidity, which we'll look at next. But on these kind of days, it's really important to ask yourself, what is my long-term thesis? Why am I investing in what I'm investing in? And make sure that that still makes sense and you still have that conviction. Regardless, with the thesis out of the way, I know I've shown this before. Let's dive into the actual data. What we usually do, we'll take a look at the charts. So the main thing to note here is that on the top in the white box, you can see liquidity has sort of rebounded, although we're still ranging here, right? Last week, we were about to drop under the MA. It has since mean reverted a little bit, and we're kind of heading back up. Hopefully, I think into the end of the year, you'll see liquidity expand. On the bottom on the regime tracker, we're right near the low of this channel. So we're still above the midline at 50. But we're right at the low of this channel. Could we go a little bit lower? Possibly. But I think historically, these have been excellent times to add, as you can see here on the chart, going backwards. So if I can actually show you, it would be this point, this point. Of course, we did still have some lower price performance. It caught up. And also these points here, which we're at now. So important to, again, zoom out and ask yourself why you're doing the things you're doing. And today is a perfect day for that. So regardless, do have some more charts, and I have some special short-term stuff in store. But before we get to that, this was another chart I made earlier this week, which is just showing why this cycle is different, right? The last three, or the first three cycles, you had retail FOMO blow-off tops that really pushed Bitcoin to the max, and then you had severe drawdowns for the bear market corrections. This cycle has felt different because it is different. We've had a sustained institutional bid this cycle, and I still think that Q2, Q3 of next year is when we'll actually peak, and we're going to be seeing a lot higher prices. I don't really love to give targets, but if I had to put a number on it, it would be 150 to 200K, something like that. So still a lot of room to run, in my opinion. But with that chart out of the way, let's take a really quick look at, we started using this last week, or I shared this last week. And again, obviously still bearish. You can see the MAs are still bearish. So what I wanted to share, and if you follow me on X, I've been posting this. I posted this chart last week, and I have some notes here. I decided I'm not even going to take it off because this is my plan. And you can see what my plan is in terms of IBIT calls and getting some leverage at these prices that are out for June 2026. Because again, my thesis has not changed. We are going higher in my opinion, and the best is still yet to come. So I posted this chart last week on my X feed, and right in this area, I started selling calls against my spot position. That worked out perfectly. I sold more calls on this bounce here. That worked out. I am no longer selling calls against my position. These are short-term calls, by the way. They're weekly calls. I am now starting to DCA and buy June 2026 IBIT calls. Again, this is not financial advice. This is just what I'm doing and my opinion. And you can see how I've kind of drawn up the buckets here and what deltas I'm looking at for the calls themselves and what strikes. The expiration is, again, June 2026 for these. So that's pretty much it. But the main thing I wanted to call out here was Elliott Wave theory has really worked incredibly well and continues to work incredibly well. I just started learning Elliott Wave probably a month and a half ago. I do follow some analysts. I do pay for some stuff as well around Elliott Wave that I don't necessarily talk about on this show, but maybe I will. If you do enjoy this, leave a comment and maybe I'll add it to the weekly breakdown. But when I posted this chart last week when we were here, I had this red 5-wave downward impulse drawn out with the C wave target. You can see we're almost there. We're at about 105,000 with the C wave target being at 101,200. So could we still potentially have lower prices? Sure. But I think regardless, the risk to reward here and where we're at now, I'm starting to really load up aggressively with the cash that I had on the sidelines. So that's pretty much it. If you want to know more about Elliott Wave, I suggest just doing a YouTube search for Elliott Wave theory for beginners or something like that. But it really has worked wonders and has let me manage my portfolio and sleep better at night. So that's pretty much that for the charts. Let's take a look at some of the data. And with the government shutdown this week, all the data that we showed last week that was supposed to come out this week, CPI, PPI, all of the other stuff, none of it came out with the government shutdown. So all we had was Mr. Powell speaking earlier this week, which I'll briefly talk about because he was actually very dovish, saying that they're going to end the runoff and stop QT, which is quantitative tightening. All positive things, means more liquidity going forward. Empire State Manufacturing Index and Philly Fed Manufacturing was really all the data we got. And whoever does these forecasts, they're never even close. So these people should be fired, whoever's making these forecasts. They're always terrible. Regardless, Empire State beat by 9 points and Philly Fed missed by like 20 points. So I don't know, whoever's got this forecasting job for these, it's like trying to, do the weather. You could just be wrong every day and you still have a job, but whatever. Regardless, I think we're trending, you can kind of see in the right direction, which is up. And in terms of the business cycle, that is a positive and should be potentially positive for the ISM flipping and going into expansion above 50. So some of the other things I did last week, which I started, which was new, which was my notes. So we could take a look at my notes from last week really quick to kind of review. I think Q4 might actually surprise people. It might be weaker than people expect. Everyone is expecting a hyper bullish Q4 and Bitcoin tends to do the opposite or what people least expect. Stock market is at all-time highs and super stretched. Numerous indicators are stretched. And I listed out all the different sort of sentiment indicators that were really stretched and flashing warning signs about all-time high valuations and a potential correction, which I mentioned last week, which seems to be playing out. For this week, I wanted to talk about what Jay Powell said earlier this week on Tuesday, which was in regards to the reverse repo and sort of mentioning the TGA. And I have two related tweets for this. So I figured let's take a look at the tweets. And this is a ChatGPT explanation because it can dumb things down way better than I can. So let's take a look at the tweets. I know we're kind of jumping around here really quick, but I think it's important. So Andreas, amazing analyst, definitely give him a follow. Most interesting trend today is that financials and regionals are getting hammered. There is a regional banking crisis. That's some of the news for the sell-off, but there's always a catalyst. The thing is, what gives the market reasons to wobble this time around? Before it was tariffs, yen carry trade, all this other stuff. Right now, it's a regional banking crisis. So you have the SOFR Fed fund spread, and you can see it's sort of accelerating and not stable, which is giving stress. So it's a stress gauge for dollar money markets. If the SOFR jumps above the Fed's fund rate, it hints at tight collateral and reserve condition, which is basically funding stress. Stress usually forces the Fed to ease, which they've already mentioned. Like I said, Jay Powell said they're going to be officially ending QT. And another thing I wanted to call out here in terms of the tweets really quick is Quinton here. So Federal Reserve reverse repo facility is plummeting. QE and money printing will start aggressively when this drains to zero and Bitcoin will explode. Does that mean it's going to explode tomorrow? No, this takes time to get through the system. It's not like liquidity just hits overnight and boom, asset prices are going up. Things have to reprice. And here's a chart of the reverse repo. You can actually find this on the FRED site, so the Federal Reserve whatever website. You can get this data yourself. I have it for my website as well. So if you look at some of these liquidity metrics that I show here, these have TGA and RRP minus from the WALCL. And then this basically gives me a net Fed liquidity score, whatever. You can check this out on your own whenever you have time, but that does take into account the TGA and RRP. So you might be thinking, what the hell is the RRP? It's an overnight parking lot for cash. Think of it as basically the Fed's checking account. When money market funds can't find a better place to earn a safe yield, they park dollars at the Fed overnight. The TGA, okay, so for money markets, TGA is the checking account of the Fed. When the TGA falls, Treasury is spending money into the economy. When the TGA rises, Treasury is issuing more debt than it's spending and pulling cash out of the system. So how do you actually use this in terms of Bitcoin? Well, it's very simple. P down is cash leaving the Fed's parking lot, entering T-bills and banks, easier financial conditions, risk assets bid, BTC tailwind. TGA down, government spends more than it issues, it injects dollars, looser liquidity, BTC tailwind. And basically the opposite if TGA is going up. So RRP is down, TGA is going down. SOFR Fed fund rate spread is, if it goes up, like we saw in the tweet from Andreas, which was right here, this pushes the Fed toward ending QT, which will add liquidity, and it's medium-term bullish for Bitcoin. So that's basically it for the notes. I hope this helped you kind of make sense. If you ever hear things about the RRP or the TGA, you'll have an understanding of what that means. People like to use super fancy words in finance just to make normies feel stupid. But once you actually uncover what it means under the surface, it's usually very straightforward. This is the same thing with the 2008 global financial crisis when they were doing these tranches and subprime lending and all this stuff. It's just fancy words to make normal people feel dumb and not understand what they're actually buying. Now that you have ChatGPT, you can look all this stuff up yourself, and it's pretty self-explanatory once you break it down in layman's terms. So that's it for the notes. Let's take a look at the Fedwatch really quick because there was a big update here. It's a lock for the end of this month that they will be cutting 25 basis points. There's a 1% chance they might do a 50 basis point cut. I don't think that's going to happen. But what's more interesting to me is for December, you can see there's a 9 or 10% chance that they're going to do a 50% cut in December. So this would be another 25% cut, which is locked in now at this point. And we'd be down to potentially 325, 350. So keep that in mind. For January, there's even a 5% chance of yet another cut. So about 50-50 for just one in January. So that's it for the Fedwatch. They're cutting. That's it. QT is over. If you ask me, I don't think that's going to be going back until inflation starts to rear its ugly head. And I don't really see that happening until late 2026. Regardless, that's the Fed Watch. We can move on to maybe what you're here for, which is my system, which lo and behold, no surprise, we are still risk on. This hasn't changed. All the institutional research up here in gold is still bullish. Even with the price performance now, it is still bullish. And one of them is still extremely bullish. So keep that in mind. Everything else here, again, is more, I wouldn't say shorter term, but can show you good places to DCA. I mentioned this last week. Whenever this barometer in a bull market gets under 80%, that is usually a great time to add to your positions, which is what I'm doing. So with that out of the way, with the system in the books, let's take a look at some of the actual inputs. So the DXY trend filter, again, this is going to stay bullish for a very long time. Now, it is important to note that the dollar has rebounded, so that's helping the weakness in the markets, but I'm not really concerned about that. I think still the overall trend is down. For the MVRV Z-score, this has signaled risk off, which usually means a good buying opportunity. As you can see for this cycle, it has basically caught the lows. So what was really fascinating to me was that this last pump to all-time highs did not send this bullish. So if you were following just this, you did pretty well. Each realized price, same idea. Every time this goes to risk off, this was a great time to add in a bull market this cycle. So again, it is risk off now. And what am I doing? I'm adding. Bull bear cycle drift, not much to say here. It's trending downwards, but still in a bullish phase. So that is good. And that has not changed for this indicator since the sort of start of the bull run in 2023. Cool. With all of that out of the way, there was one thing I wanted to note, which is actually one of the tweets that we'll take a look at in just a minute. But if you go down to whales and short-term holders, one of the things I'm still concerned about, which is these two charts, you can see that whales are still selling, or long-term holders anyway, not whales, let me clarify. And short-term holders are buying. Historically, you want the reverse to really signal a bottom. So this has been kind of the one weird thing in this latest price action. I'm not going to marry this because it doesn't always work, but it is generally a good representation. Long-term holders are usually smart money and are buying when they think the risk to reward is better. And short-term holders is usually retail and dumb money. So we'll see how this kind of pans out, but nothing else too important in these charts. You can see retail investor demand is still basically at zero, which is good. And smart DCA obviously signaling that this is a good area to buy. So that's pretty much it for the on-chain stuff. We can look at the liquidation maps, which again, take these with a grain of salt. I see these all over my feed. And while yes, it can act as a magnet for price, it is not prescriptive or predictive. So the 2-week one, you can see all the liquidations have been liquidated. Good to see. If we zoom out to the 3-month one, pretty much everything has been cleared out. So in my case, in terms of the Elliott Wave stuff, like I mentioned, I still think we could see 101 to 102, but this could be the bottom. It could. I mean, we already hit 103.6. Elliott Wave is not perfect, although it can be pretty close to that, but we already hit some pretty low numbers within this target. So this could potentially be the bottom. We'll see. We'll definitely be updating it when we meet again next week for the next macro war room. But let's take a look at some of the tweets I had lined up for this week. So Frank here, great account. BTC is up 6.5% or 6.5 times, off the bottom from over 1,000 days ago, which is basically 3 years. Markets are hard. People tend to make the exact wrong decision at exactly the wrong time, watching for time-based capitulation. It's easy to forget that we were in the beginning of this cycle. We can pull up the chart. We started this cycle at basically 16,000, 15,000. We're now at over 100,000. People forget. People do not think about that Bitcoin has already 7x. It just took a lot longer. There wasn't as many insanely parabolic moves. There was deeper retracements. It was more chop going up. So the price performance is there. I think short-term traders and people with a short-term outlook just continually get wrecked. You can see here the performance since the cycle low. And again, I think this cycle is different. It's extended because of the debt refinancing shift and all that other business cycle weakness that we've had in the ISM. So anyway, whatever. J.A. Martin here. Long-term holders are cashing out. This is the exact chart I just showed. You can go to watch this yourself on my crypto quant. But basically what I already said, that LT is selling, which is strange. We went over these already about RRP and TGA. And the last tweet I have is from Chris Tipper. The US dollar's downtrend pause is moderating global liquidity's upward momentum, countering boosts from injection and calmer markets elsewhere. Again, we took a look at this on our main chart where we've been basically chopping with global liquidity, global M2, while the dollar has kind of rebounded. So I think if the dollar continues its downtrend, this will continue higher and we'll have more liquidity entering the system. Again, this year has been mainly driven by China M2 printing, not the US. If the US is now officially ending QT and doing QE, that will be a huge boon to asset prices. And I think it's going to catch a lot of people off guard for the rest of this cycle. I know a lot of the top callers on my feed are celebrating, having a parade, saying we were right, 124 was the top, I think they're going to be sorely mistaken. But we'll see how this plays out. If you made it with me this far, first of all, thank you so much for watching. I do these weekly on Friday morning. If you did enjoy the video, you know what to do. I'm not even going to ask you for it. An important thing to note, when we had the yen carry trade disaster or sell-off or crash or black swan, whatever thing you want to call it, I remember sitting up that night and thinking, reading my feed, and it was all doom and gloom. It's over, it's over. And I had to literally force myself to hit the buy button. I had that pit in my stomach feeling. I had to force myself to hit buy because I knew what my thesis was. And it's the same today. We're just at higher prices. So I'm continuing to do what my thesis has laid out, and I will stand by that conviction, ride or die. We'll see if it's right or wrong, but I hope that helped to give you an insight into sort of how I think about things. Again, cheers for watching if you made it all the way to the end with me. I appreciate you. So have a great weekend out there, and I will see you next week. Thanks for watching.